Hello everyone, and welcome to the fundamentals portion of the newsletter for August 16th. I know I promised you all a catch the dip on-chain section. Unfortunately, my code has decided to upgrade itself, and I've broken a whole bunch of my links. So if you can bear with me just while I clean that up and debug the code for the week. Thankfully, in our wonderful world of cryptocurrency, there is never a dull moment, and in particular, the DeFi craze that has gone on of late in the last month and a half or so has certainly given me more than enough to talk through. So if you can bear with me on the on-chain portion, that will be back up and running within the week. So what I wanted to go through today is really what on earth happened in the last month and a half. So some of you are probably following what's going on in DeFi more than others. I'm certainly watching it somewhat from the sidelines, just seeing what's going on crypto Twitter, trying to keep my finger on the pulse on what's happening. And I'm not going to lie, it is really hard to keep track of everything that's going on. There is no question that it is an absolute whirlwind, and it is really what it's just gone through is almost like a mini bubble, in my opinion. It's gone through from, kind of innovation and, a first launch of, we'll talk about the progression of things, but the notion of liquidity mining kind of showed up with the Compound team. And between now and then, and if you can believe it, that was not that long ago, it's basically gone through a complete hype cycle, very, very similar to a miniature 2017 ICO bubble, where things went from being actually honestly built and structured in a way to try and create some kind of, new incentive model and get people using these protocols, to absolute degenerate chaos where we had a blow off top and tokens that were being released that were absolutely valueless, and eventually we had a mini implosion of one of the major crazed coins. So what I want to do is just kind of talk through from my perspective and take all of this with the fact that there is no way that I understand even, I would say even, I'm probably missing 90% of what actually happened. I've probably got a 10% scratch the surface. To be honest, it's a full-time job to track just DeFi alone. Sometimes it's a full-time job to track even one of these protocols. But I'll certainly do my best to try and capture the story arc, at least as I observed it from crypto Twitter. So let's go on a bit of a whirlwind tour of DeFi. So what actually happened? So in the span of 2 months, which quite honestly does feel like years in crypto, it certainly ages you in a way that nothing else does. It all really started with Compound launching their liquidity mining protocol. Now, the notion of this is it basically you lock up capital, and it's an incentive by giving you comp tokens. It brings people to start putting liquidity and actually using the protocol. The idea is it's trying to distribute those governance rights and the token as an incentive, much the same way that Bitcoin or any of these other protocols releases the native coin to attract people to using the network, miners and so forth. The notion of this is to bring users in and try and bootstrap users by giving them access to the comp token. And, within a few weeks, it launched a liquidity mining craze. Suddenly Lend, which is now Aave, blew up and started doing their liquidity mining. Synthetics had theirs, Balancer had theirs, and they started cross-pollinating. You lock up in Synthetics and you also get Ren token, lock that up there, and you get Aave. Like suddenly liquidity mining, within a matter of weeks, just blew up and was all the rage. This was followed, the next kind of major piece to this puzzle was Ampleforth, which some of you follow, launched. That had launched some time back, but it started to gain a lot more traction and attention, particularly on Uniswap as a trading pair. It really started to get some attention. And then a token called YFI, which people have got all manner of Wi-Fi and Yiffy and all sorts of other things that they pronounce it by. But Yiffy was a token that launched and had kind of a unique fair launch, in inverted commas, fair launch type system. And had different layers to it was almost like a hedge fund on chain. And when you start looking at the Compound governance layer, the Yiffy launch and the Ample rebase and these kind of interesting tokenomics, suddenly we started getting all manner of clones. We got Wi-Fi 2, we got Wi-Fi with 3 eyes, we got anti-Ample, we got Ample Yiffy, where people started gluing these different tokens and their structures together to create kind of mutant babies that then all got listed on Uniswap. So suddenly we've had not only a liquidity mining craze where people start paying attention and committing capital to these things, we've now got all sorts of random clones and people taking the bits of Lego and gluing them together to create all manner of different token sets. And the final piece of this whole story was Yam Finance, which essentially was a single day, 24-hour event where it was all the rage. The thing was supposed to be pegged at $1. It got up into the hundreds of dollars. And next thing you know, it did a Thanksgiving turkey and basically imploded in one day. So, some people call it a experiment, some people call it a scam, and there's everything in between. But we'll talk through that whole series of events shortly. So what's actually going on here? Ultimately, DeFi is attempting to bootstrap users. It's trying to bring people to using these protocols that otherwise there's no incentive to use them. They're doing this via things like token giveaways. They're doing it via yield farming memetics. So they've now created the notion of yield farming as it's something that people can use to describe and talk about what they're doing. It's a very simple and easy concept to grasp. They started cross-pollinating liquidity, so gluing different protocols together and creating pools that kind of balance between each other. And ultimately, what they're trying to do is crafting incentives. And I put incentives here in inverted commas because I'm not entirely sure that the incentives are well crafted at this point in time. But they are drawing on the one thing that we can absolutely be reliant on. And to be fair, is the thing that makes all cryptocurrency tick, and that is human greed, right? It is the one constant amidst all of these things that we can absolutely rely to exist here and in perpetuity. So human greed is really what drives all of these things, and everything else is basically a wrapper on getting people to exploit that particular emotion. So let's go on a bit of a story where we unpick the hype and start looking at these things a little bit from let's just simplify and boil it down to its core reason for existing. So Compound launched the notion of liquidity farming. The idea is here that if you're a depositor or a withdrawer, if you borrow funds or you deposit funds or both, you earn comp for doing so, proportional to the amount that you lock up. And what the incentive this is doing is the incentive at the end of the day is for people to take on leverage. And then the smart people will take on leverage. So they will deposit an asset, they will borrow against it. So they've now taken on leverage. They then swap that token and then redeposit. And then they re-leverage, and you do that a number of times, and you push because you're now borrowing the maximum but also lending the maximum. So the idea is that some of these interest rates start to offset each other. If you're borrowing one asset for 2% but you're supplying one for 1%, then your effective rate of return there is 1% cost, right? And the idea is that people started creating these smart contracts that would do all of that in one cycle, right? Borrow, swap, deposit, borrow, swap, deposit, borrow, swap, deposit. And whilst you may have deposited 2 stable coins, right, and you're only accruing interest at like 1% or 2% or something like that, the problem is that when you go to unwind all of that, every single asset that you've locked in there has a debt obligation. And particularly when people are borrowing against risky assets like Ethereum or basic attention token or any other one of these things, you're now subject to the price fluctuation of the oracles of what actually is going on there. So if suddenly the price of Ethereum was to drop substantially, you would have to remove collateral, sell it for the stable coin, and then pay back the stable coin. And then you'd have to repeat that reverse cycle. But the problem is that because you've re-leveraged and re-leveraged, what you've actually done is you've pushed your liquidation price higher and higher and higher. And many people didn't understand that there's actually a very significant cost to unwinding all of this leverage. And when you go to actually undo it, it's a much slower and more tedious process than what it is with a single click login type system. So, this was kind of what started this whole craze but what it really does is it incentivizes leverage and debt. And if you kind of look at the modern world, it's not necessarily the best thing to be incentivizing. So in my view, what Compound should have done is they should have had, if they're distributing comp to 75% to depositors, so there's more incentive for people to deposit and less incentive for people to borrow. And the idea is that people would then find a more natural equilibrium to this whole thing. Now, what is worth saying is that Compound launched this whole scheme back in the back end of June, if I'm not mistaken. And I hear nothing about Compound Finance right now. There's just not even in the crypto sphere whatsoever. Everybody is talking about every single other token that's involved in it. So, it kind of shows that this is somewhat of a fleeting thing. Whether all of these incentives actually create long-term users, I'm not entirely convinced. I think that people will just continue to move on to the next thing, which is a key point that we'll talk about later on. And this opened up the whole world of liquidity farming. So from left to right, we've got Synthetics, Balancer, and then Curve Finance. These groups are all now doing various pools, and you can see that you're earning multiple different tokens by supplying different sides to all of these liquidity pools. So really, this has now become everybody's jumped on this bandwagon. And what I find very interesting, and again, you'll start seeing a lot of parallels to the 2017 ICO boom as we go through this story. You'll start seeing that, I very, very strongly do not believe that all of these different protocols had planned liquidity mining, because it's like Compound launched it and then suddenly it's bang, 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 one after the other. All of these things go, yeah, look, we're doing liquidity farming as well, right? Let's start pushing out these protocols. Every man and his dog can write a white paper and issue code, and in these in this era where it's basically copy paste, you can take free open source software and manipulate it for your own needs. Suddenly everybody's gone, that's the missing piece to the puzzle. That's how I launch a token. So there's a whole bunch of these different protocols that all went down this path, and I'm not convinced that they were all planning this from day one. Maybe they are coordinating in the background. I don't know, but I think that a lot of this, the timing of all these things, to me tells me that they basically launched all of this after seeing the success of Compound. And to be honest, it kind of dilutes the idea over time. So the next one is that Ampleforth, which is it's one of the more interesting token designs that exists out there. It's existed for some time, and really it's only been, you can see in the price chart there, it's on the volume and the price action. You can see that it really only picked up some kind of attention back in July, start of July. So the way that Ampleforth works is, instead of, it's a bit of a complex thing to get your head around, but with Bitcoin, for example, you are buying a fixed supply asset, so you know how many BTC you have. And what goes on is that the price of that BTC changes. So if you wanted to go and buy something, you would have to check the exchange rate to see how much BTC is worth in fiat denomination. You would then convert that to an amount of BTC that you need to pay the person to acquire whatever the good or service is. Ampleforth, the notion of it is it's supposed to be targeting to a $1 peg. So AMPL is supposed to be set at $1, and there's an oracle that helps achieve this. Now, if price goes higher, what happens is that the coin supply in your wallet actually expands. This is called rebasing. So if price suddenly goes up to $10, let's just say for ease of access, price goes to $10, that means it's now 10 times higher than the peg. What's the easiest way to actually get it back to its peg? Well, if you create 10 times the amount of tokens, so every one gets split into 10, suddenly you've got 10 times the supply and this, the same amount of market value. And the idea is that it should rebase or drop the price to $1, because you now got 10 times the supply, 10 times less scarcity. And conversely, on the way down, as the coin price, if the price goes below $1, it actually constricts the supply or shrinks down the balance in people's wallets. So really the incentive in this whole thing is that you want to be buying Ample very low. From a trading perspective, it kind of makes sense. You want to buy this thing very low, right? Particularly when it's below the peg, because the intention is that your ownership of the market cap, right? You will always have the same percentage share of the network. That's the notion here. So when it's very cheap, the idea is that you can buy a larger portion of the market share than when it's not. And because it's still a free floating asset, people can still bid the price and change it. And only after a set period of time will it rebase. What you can essentially do is, if you buy something at 50 cents and then people jump on that bandwagon, it suddenly pushes the price up above $1. What will happen is that the supply will begin to expand. So you've bought a large share of the network very cheap. As price starts to move upwards, your share will remain the same, but the number of coins you have expands and expands and expands. And ideally, if you can get in very early, you ride up through the first rebase, suddenly you have more tokens. Because of this price momentum, it's very much a trend trade type strategy. The more people then are buying into this hype and pushing the asset higher. And the relative value of it in BTC terms, you've suddenly got 10 times, maybe 50 times, whatever it is, whatever the rebased multiplier is. The idea is you want to be holding all the way to the top. You ride up all these expansions. You've got more and more coins. and then you can sell those at the top. You want to be the first one out the door, right? When the selling really starts, you want to be the first one out, because then you've sold your fully expanded rebase supply of asset for BTC or dollars or whatever it is, right? You want to be selling it when it's above the peg. And this is kind of the idea that they pitch for this project. The idea is that, you know, market makers will always try and target it to $1. So therefore, there's going to be lots of selling and lots of buying as it gets further away. And long term, in theory, it's supposed to reach some kind of equilibrium, right? It's supposed to have massive, massive volume to achieve this. Where I kind of have an issue with this whole thing is that it's actually reflexive to both sides. Now, the exact converse happens when it moves into a downtrend, and you can see in this price chart that it really seriously collapsed very quickly. What happens is, as price starts falling, once people realize that you're in a downtrend, because price is going to be falling very rapidly, what people are going to be doing is actually trying to exit very, very quick, because what they don't want to happen is the price to go below $1 and then the amount of coins they have to constrict, right? If you sell when you've got an expanded supply, right, you can cash out at the current price with more tokens. As soon as it rebases, anybody who hasn't sold now has fewer coins, but most likely at a similar price. So there's this perpetual sell action. So it's kind of a momentum play both to the upside and to the downside. So it works both ways, and the supply is never actually stable. So I really think that ultimately Ampleforth to me is it's a Ponzi scheme, right? It's a casino game where the idea is that rather than price changing and you checking how much BTC you have to send, price changes and you have to check how much Ample you have to send, right? The whole notion of it is that your supply is constantly changing in your wallet, and you never actually know where you are in the rebase cycle. So you always have to go back and check the Oracle to see whether you're about to get rebased up or down, and that will impact whether people want to spend or not. So it's actually a very poorly designed system, in my opinion. However, it has what's called Ponzonomics built into it. It's strange that we actually have this term now, and people are using it openly, Ponzonomics. But it's gaining traction. But what this Ampleforth did is it introduced the ability to expand and contract supply in someone's wallet. So that's kind of the key piece to take away from this. Now, the next one to launch was YFI, and what this really is it launched as a fair launch approach, and you can see highlighted up there, we've released YFI, a completely valueless zero supply token. We iterate, it has zero financial value. Well, the thing mooned up to about $6,000. So what YFI actually is a hedge fund on-chain, more or less. It's kind of like, if you can think about Set token, how it kind of pre-builds different strategies. The idea of YFI is that you lock your coins in there, and the strategy will go to seek out whatever the best yield farming opportunity is, right? And people are supposed to get accrue value based on that regard. And the idea is that the governance rights are supposed to be slowly decentralized, right? And the more people use this protocol, the more YFI gets distributed. And what ends up happening is that because it's a fair launch, everyone calls it out. Wow, this is amazing. First fair launch DeFi, everything needs to be this method, and price just mooned. And the incentive to farm it mooned, right? Suddenly you've got something that's worth $6,000. It was worth $30 when it kind of initially hit markets, and it just built hype. And DeFi, everyone was saying, is just going to the moon. And the risk involved with all this is that people stopped considering risks in any way, shape, or form. This is where this token was kind of it was one weekend where it launched. And this is really where people just completely flew off the handle and said, wow, DeFi is just amazing. You can't lose. And people started throwing darts, right? Because the darts could not miss. And this is where things started to get a little bit chaotic. So just to kind of recap, the Lego pieces that we currently have in play, we've got liquidity mining, which is like cross-protocol leverage plus the issuance of governance tokens, in inverted commas. We've got rebasing supply assets, which has created the notion of Ponzonomics plus hype by design. You can kind of consider Bitcoin's halving as Ponzonomics or hype by design. Ampleforth took this to a whole new level, because you want to be getting in before everyone else, and you absolutely want to be getting out before everyone else, because the thing it's just going to be an oscillator around that $1 mark. The trend trading is there, but you don't want to be on the wrong side of a rebase. And it also creates a very big risk, in my view, that if the contract has a bug in it somewhere, you can never ever audit the supply of these assets. You can't, because they're constantly rebasing and changing. The ability for them to be transparent is dangerous, and we'll see how this actually plays out shortly. These tokens are all very governance heavy, And what we're actually finding, and Hasu wrote an excellent piece on this about YFI, is that these are actually custodial smart contracts. The governors of the system own all the tokens that are in there. If they select to actually drain the protocol, drained, right? So you must be very aware when you use DeFi that they are custodial if they are governance heavy. If they are governance tokens, the governors can take your coins. They are not yours. They are now locked in a custodial smart contract, which is basically a multi-sig wallet that you are participating in. You can withdraw at any time, but the governors can do whatever they want to that particular smart contract. Obviously, there's some cases where they can put roadblocks and time delays and stuff in, but you should assume that all of these smart contracts are custodial. So that's just a take-home risk. And ultimately, Uniswap is there, which is a free and fair listing of literally anything. This is how all of these clones, these other tokens, these YFI2s and anti-ample and amplify and all these other things, people are just shilling this stuff on Twitter, and you could list anything and suddenly price would just go up, right? And amidst all of this, the way that the coins are actually issued, the liquidity mining, very, very small token supply up front. So what that means is that a very small bid will push prices substantially higher, right? Small supply, even a moderate demand, and suddenly price just goes through the roof. So these are kind of the Lego pieces that created what's about to happen. So the Ponzi-nomics acceleration. You can see here. I mean, this is literally a volume chart from Uniswap. You can see the absolutely explosive parabolic growth over the period of what is this, a couple of months, 3 months, and the gas prices essentially pumped up to 250. We got up to 300 and something the other day. So we really did start to see extreme gas prices as people were basically paying $30, $40, $50 Uniswap transaction fees. Just to try and get something in, because things were pumping to such an incredible rate that it blew everything up. So, this is kind of something that we started to see. This was really the start of the acceleration, and you can see it really kicked off in July. So we're really only talking about a month and a half worth of extreme volume and volatility. So then came Yam Finance. This is the latest hype that basically was a 24-hour period of pure chaos. It combined all of the hyped features. It was liquidity farming on all of the coins, and you can see on the right-hand side that basically you could drop your farm into any. It was basically an automated system where you could farm any of these other protocols. So it was the poster child of composability. Yam itself was a rebasing asset, so it had taken the Ampleforth rebasing contract and applied it to its token. It was supposedly a fair launch token, right? You could only earn it by participating in any of these farms. And it was a full governance token, much the same as YFI. And it actually introduced a new hyped feature amidst all of these things: a complete and utter lack of audit. So whilst they basically released this particular protocol without ever actually auditing the code, and you can see here that this was a 10-day project from start to launch. So they've got their disclaimer: we strongly urge everybody not to use it, consult a professional audit, blah blah blah. What do you really think is going to happen when this protocol launches on crypto Twitter? There is no chance that anybody is going to consider this as realistic. People suddenly threw millions of dollars. This thing ended up getting up to over $500 million locked inside. I think it got up to 750 million at the absolute peak within a 24-hour period. Absolute insanity. And in my personal opinion, it's just what's the correct word here? It's just irresponsible, to be honest, of the developers to actually release something like this that has no audit and the expectation that, you should have done your own research. This is really poor form, at least in my view. So, when you combined all of these elements and not come in with any form of audit, it's pretty poor. And it was kind of indicative of the hype cycle that there was just nobody paying attention to any of the risks. Because people were willing to pay $50 Uniswap fees to get onto literally anything that was going 1,000%. So this is kind of the launch of what actually happened. So what ultimately ended up happening is that there was a bug that was found. So because Yam is a governance token, you need to be able to reach quorum, right? A sufficient number of votes to pass any kind of action. Now, what Yam was doing is it had a treasury, and every time it rebased, it was pulling liquidity pool tokens from Curve Finance and depositing them in the treasury. So the idea is that the more people were buying YAM, the more the treasury would grow, and it would start accumulating other people's liquidity tokens, right? Other protocols. Now, what ended up happening is that they forgot that the governance quorum was basically the governance quorum was a set number of YAMs that were required. But because the treasury was also accumulating liquidity pool tokens, the treasury was also accruing YAM. And after the first rebase, what had happened is the price had jumped from $0 to $100 and something. And because price was so high, it accumulated an enormous amount of liquidity pool tokens from Curve Finance. Those liquidity pool tokens were actually creating more YAM than was outside the contract than was inside. And what ended up happening is that there was so much YAM inside the treasury that couldn't be retrieved, that there was no way they could reach quorum, right? So YAM inside the treasury was the ultimate governor, but no one could access it because there wasn't enough quorum to get access to the governor. So what essentially was happening here is that it was accumulating. The more price went up, it would start accumulating more liquidity pool tokens, and this thing just went absolutely parabolic. So what they had to do is they had to try and get the community to actually jump in and save the protocol to try and reach quorum. So, and this is all happening in a 24-hour period. So this is about 12 hours in, this started to kick off. So what ended up happening is that gas prices from people participating in the network were up at the 300 mark, right? So things are getting very expensive for people to participate. And what did end up happening, surprisingly, is that they needed to get a quorum of 160,000 YAM. They ended up getting a number of benevolent whales who basically stepped in and supplied enough YAM, and even Arthur Hayes from BitMEX was getting involved in this thing. So everyone was involved. So they reached quorum. Happy days, right? Everything's going well. Until they realized that there's actually no way for them to, even though the proposal had enough YAM, the rebase that was occurring inside the contract was so large that they just could not. There was no way that they could actually fix the proposal. So Andre here, who is the author of YFI Protocol, basically said it's time to get out. People, even though we've reached quorum, you have to get out because the thing is essentially it's corrupted, and the governance-heavy system is unable to save itself, even though it hit quorum. So the concern is basically the same. The amount of YAM that was accumulated it means that you can't actually pass any form of governance proposal. So they basically released a thing saying that, despite what's going on, we actually think that there's still a problem. And ultimately, the author, posted out, sorry, I've failed. It's been insane, but the thing has basically imploded. And you can see that the market value of this thing, it literally looks like the Thanksgiving turkey chart, where it, days of happiness that it's alive, it keeps going up and up, and until one day, bang, gone. So this was all in a 24-hour period. The thing, and you can see down the bottom here that we're actually talking about, hours, not days, that this whole thing occurred. Price pushed up into the hundreds of dollars, and then next thing you know, it's basically gone to zero. So what comes next after this complete whirlwind? Well, overall, DeFi in some form is probably here to stay, but in its current format, it is extremely unstable. Ponzinomics is now broadly applied. It's actually, people are really targeting, applying Ponzinomics. It's some weird thesis where the more Ponzi-like your DeFi token is, the more people are going to participate, and the better you can bootstrap your thing. Do I hear anyone talking about compound? Not really. So I don't know how long these incentives really last. I think once they're expired, people just don't care. Largely, the risks have been ignored. The smart contracts are custodial, and ultimately, no one cares. Right? This is kind of the degenerate world that we're in at the moment, where people are just looking for price gains. They don't care about the protocol. No one's going to be getting any kind of religious zealotry about any of these protocols. Some of them they may, but at the end of the day, I think that a lot of this is fleeting. A lot of this is kind of a flash in the pan, which of course is profitable if you can jump on board at the right time in the right place. But I'm certainly not convinced that any of these things have the staying power that is required, nor the stability to actually change the world of finance. I think, sure, we'll create new incentives and new primitives and stuff like that, and the innovation is very cool. But I do believe that it's very risky and dangerous with people's people's money. So of all things, we already know that cryptocurrency is fairly risky as a market as is. This is really the riskiest part of the entire. This is as risky as it really gets in this particular space. So just be very conscious of this. And what comes next? Well, the scalability is back on the agenda. We saw with 300 gas prices that CryptoKitties is basically back in fashion. The reality is I don't think you can put all this data on chain and it be scalable. Even when they start looking at moving into ETH 2.0, all they're doing is creating 64 times the same problem. Sharding is really, in my opinion, not actually a solution to this. What it does is it just means that rather than having all of your nodes looking at a single chain, you've split your nodes into groups of 64, and smaller groups of nodes are looking after each chain, right? Each subchain. We're seeing centralized exchanges. So Curve Finance is the latest token to launch. And basically within a matter of hours, Binance was saying, yep, Curve is now listed. So I think that centralized exchanges are going to start getting a piece of all this action, particularly because the gas fees are so high. What's going to end up happening, in my view, is the exchanges will start participating in DeFi on behalf of their users, and returning some kind of yield. And more or less, the average person will be priced out of using decentralized finance. They'll be able to earn some kind of income from centralized exchanges and automated market makers and hedge funds, more or less, taking advantage of any kind of arbitrage opportunities that exist. So I think this is where we're going to end up. And Ponzinomics is ultimately creating more of a casino finance than a decentralized finance. And take this as what you will. Maybe this is the way forward. Maybe that degenerate gambling is actually the way that all of this is headed. Maybe that is the way of innovation. I'm not sure. It's certainly nothing that strikes me as being an improvement over our current system. Perhaps I'm too principled in that front, but there's opportunities here to make money. But be very aware that this really is casino. It is a casino at this point in time, and it's very, very similar to the ICO craze. And when the bubble finally does pop, which I don't necessarily think is now, when the bubble does pop, it will unwind very quickly and it will hurt a lot of people. So I think if there's a word of caution in all of this is don't be the person selling last. You want to be, if you are trading this stuff and you are participating in it, be very, very conscious. Curve Finance is the latest example. It had such a low float of coins. So the developers supposedly didn't release the code. Someone else released the code ahead of them because it's on GitHub and someone else can just release it. They then decided to jump on board and say, oh, okay, no, that is, we're just going to adopt it because people are using it. I think it was a scapegoat way for them to avoid regulators rather than issue the token. It's now a fair launch. And, even within that, the developers had some kind of 2-hour pre-mine, and then the price of Curve shot up to like $30 because there wasn't enough coins to meet demand. At $32 per Curve, the fully diluted market cap is basically 2 times Ethereum's. Someone worked this out for me. Basically, people are just mining and selling. So it really is the little guy who's going to lose in all of this. So just be very careful if you are investing or using any of these DeFi protocols. And just to give you, absolute confirmation that this is where we're going, the thing on the left here is what's been released called the Degenerator, which is literally build your own Ponzinomic smart contract, choose your governance contract, choose your staking contract, and choose your rebase contract. I don't know where this all ends up, but I think that it looks something like our turkey chart on the right-hand side. I think that the token holder's well-being is going to deteriorate very quickly when it finally unwinds. Again, there's a lot of opportunity and gains to be made in the casino if you're playing before the bomb goes off. But what I really want to impress here is you saw what happened in the last month and a half, right? A lot. Extremely difficult to keep your head wrapped around it. I'm almost to the point now where I don't think it's worth keeping your head wrapped around it. This is where you want to be basically trading the hype and the hype cycle if you are getting involved in this. I would probably be erring on the side of using, once these tokens get listed on centralized exchanges, the likes of FTX and Binance, I think are probably the front runners in all of this. It's probably better to just be getting to exposure to these things, and I wouldn't necessarily be participating in the yield farming. I think that you'll end up getting burnt by the slippage. You'll end up getting burnt by the transaction fees, and probably the most important thing in all of this is when gas prices shoot up like that and we hit a CryptoKitties moment, you can liquidate on Binance. You may never liquidate without paying a $50, $60, $100, $200 fee. I saw people that were paying for Ethereum, total fee for ETH to actually get out of some of these trades. People just wiped their entire balance trying to exit a trade. So I think the ability to exit out of a centralized exchange is much, much higher. So be very conscious of kind of the risks that are involved. Be very conscious that people don't care about the risks, right? That's tradable opportunity there. And you really want to be getting into these things earlier rather than later, because especially with these rebasing contracts, no one's ever going to understand how these things work. And that's kind of been the saying on in various circles, crypto Twitter, and even some of the top trading chats that I'm in. People saying, I have no idea how this thing works. I don't care because it's making me money. So this is kind of the realm that we're in. Trade it as you will. Be aware of the risks. Don't trust any of it. Assume all of it's going to go down the Thanksgiving turkey path. And, if you're involved in it, have fun. If you're not, it's probably best to sit on the sidelines for a lot of this stuff. It's certainly what I'm doing. I'm not particularly interested in any of this stuff because it just doesn't really compute for me. But you can see how hard it is to keep track of things. And I would honestly be letting everyone else kind of keep track of it and, ride the price chart where you can. And just be aware of any of these assets that are rebasing, because the way that it affects the price chart is, in theory, supply should expand substantially, and it should be arbitraged back down to the target price of $1 or whatever it's supposed to be. So just be conscious of all that. So that's kind of the DeFi whirlwind. Hopefully, there's a lot to kind of keep track of. I can't do it. But if you are out there, have fun, and I'll get my code sorted so we can get back to looking at some of this catch the dip module. So apologies for that not being this week, but hopefully this whole story and saga was enough of a kind of filler. As always, be sure to grab me in the chat room if you want to talk through any of these concepts or ideas. There's a lot to keep track of, and I'm sure that as a group we'll be able to keep track of things far better than as an individual. So have a good week, and I'll catch you next week. Cheers.